Kristen Tatlock is a nationally known speaker and compliance consultant with over 30 years of experience in the credit union and compliance arena. Kristen assists credit unions with compliance issues ranging from advertising rules to bylaws, from social media compliance matters to Reg Z and the Bank Secrecy Act. Just about every regulation and compliance concern in between, she's the person you would want to talk to. She joined Ox in April 2017 and serves as vice president of that organization. Prior to that time, she was the director of compliance and regulatory affairs for the Virginia Credit Union League, a role she had for over 20 years. So lots of great experience. I know our credit union marketers are going to get a lot from this meeting today. So thank you for taking your time and presenting with us. I'm anxious to take notes and learn from you today, Kristen. So I'm going to turn it over to you.
All right. Well, thank you. And I certainly appreciate the opportunity to be with y'all this afternoon. As you probably can tell, for those of you that have not heard me speak, I am from Virginia, so you can probably tick off the number of y'alls that you will hear. I first did a program for the Maine League, I want to say maybe 7 or 8 years ago. It was my first time there. And I kind of opened with, as you can tell, I'm not from around here, but have spoken numerous times for the league in your beautiful state. Always enjoy being with y'all. Everybody is always so welcoming. So I love y'all. So anyway, let's talk about, I kind of titled this the top 5 compliance marketing compliance issues. And I did that because I will tell you, these are the top 5 things that we see when we are doing marketing reviews for our clients. Before we get into it too much, I have to tell you, I'm not a lawyer. So I'm not a lawyer. So here's what we're going to talk about. These are the top 5 issues: the share insurance and equal housing logos, what you can and can't say regarding rates and terms. Want to spend a little bit of time talking about promotional credit cards and HELOCs. I will say this is becoming more and more popular. We're seeing more and more of these. Unfortunately, we're also seeing a lot of wrong ads that advertise some kind of promotional rate or fee on a credit card or a home equity line of credit. So I want to talk a little bit about that. Then I want to spend a little bit of time talking about UDAP, unfair, deceptive, abusive acts and practices. And then we'll talk about one-clicks, because I know everybody wants to know about one-clicks. So we'll do that at the end. We're going to start with the requirements for including the NCUA share insurance sign or statement, and then also the equal housing logo or the statement. Under NCUA regulations, Part 740, what that section talks about is if you are doing an advertisement for any type of product or service, share product or service, you have to include in that a notice of insurance if you're federally insured. Under that particular regulation, an advertisement, any commercial message, any medium designed to attract attention or to promote a product or a business. So basically, kind of think about it in terms of, if you're talking about it, pretty much assume that it's going to be considered an advertisement for purposes of whether or not you need to include the insurance statement. So again, if you're federally insured. So what the regulation says, what Part 740 says, is basically you've got 4 options to comply with that part of the regulation, including the share insurance sign or the statement. So you've got 3 statements. The long statement: this credit union is federally insured by the National Credit Union Administration. Short statement: federally insured by NCUA. Even shorter statement: insured by NCUA. Or the official sign. Side note, for loan products, you don't have to include the insurance statement. The advertising statement has to be of a size and print that's clearly legible, and it can be no smaller than the smallest font used in other portions of the advertisement. So in other words, you can't hide it. So you've got the three statements, and then you've got the sign. This is the official sign. Thing to remember when you're thinking about using the sign is that every piece of this particular sign, all of that text, needs to be easily readable. So if you're limited in size, don't use the sign, use one of the statements. Because if you're limited in size, you're not gonna be able to have a sign that's big enough for all of the text in this to be easily readable. So our recommendation is, if you're limited in size, don't try to use the sign, use one of the statements. Couple of things here. Banks can say that they are members of FDIC. And member NCUA is not one of the acceptable insurance statements. I said there's three. I put them on the screen for you. Member NCUA is not one of them. So that's not allowed, it's not legal. Let's put it that way. Okay. Generally, what we recommend is if an ad is going to be seen or heard by the general public, so social media, radio, TV, we recommend including a membership eligibility statement and then also an insurance statement, and in that order. That is only a recommendation. That recommendation kind of ties in with UDAP, which we'll talk about in a little bit. So that's simply a recommendation. But if you're doing an advertisement, for membership, you need the insurance statement. If you're running an ad for a new certificate program, you need an insurance statement. If you're just saying, we have all kinds of different types of accounts, you need an insurance statement. So anytime you're doing an advertisement for your deposit accounts, shares, share certificate, share draft, money market, whatever, that's going to be considered an advertisement. You need an insurance statement if you're federally insured. There are some exceptions to the insurance statement requirement. You don't need to have the insurance statement or the sign. Well, it doesn't have to be on your ATMs. You don't have to have it on your tchotchkes, whatever you give out at your annual meeting, letterhead, those types of things. If you're doing some kind of radio or TV ad and it's not longer than 30 seconds, so it's 30 seconds or shorter, you do not have to include the insurance statement. As I said, for loans, you do not have to include the insurance statement. There's nothing to say that you can't include an insurance statement. Our recommendation, though, if you are including an insurance statement in an ad for a loan, is to use the long statement. This credit union is federally insured by the National Credit Union Administration. And the reason we recommend that is so that nobody can interpret what you're saying as being that NCUA is insuring the loan. So again, that's simply a recommendation that we make. So if you're doing any type of advertising for your share products, you need to include an insurance statement. You got several options in how to do that. As I said, if you're limited in size, use a statement. Don't try to use the sign because it's not going to be big enough. Also point out here with regard to the exceptions, you do not see an exception for social media. There is no exception for social media. An advertisement is an advertisement is an advertisement. So whatever is good for your website is good for social media. whatever you're required to include for a radio or TV ad, you have to include on social media as well. The other logo, if you will, I wanted to talk about is the fair housing logo, the dog house, as I have heard it referred to. For federal credit unions, requirements are easy. They're found in NCUA regulations part 701.31. And that section talks about non-discrimination in advertising. And what it says is that no federal credit union may engage in any form of advertising of real estate related loans that indicate that the credit union discriminates on the basis of race, color, national origin, sex, handicap, familial status. And that also requires then the dog house. For state chartered credit unions, several years ago, HUD, I don't want to say they withdrew their regulation, but they kind of changed regulation into guidelines in part 109 of the Fair Housing Act. So federal credit unions say equal housing lender. State chartered credit unions generally will use HUD's guidance. That's equal housing opportunity. So that would be in any print ad, in any social media ad, any type of electronic advertising. If you're doing any type of advertisement related to mortgages or dwelling related loans, you need to have the equal housing lender or equal housing opportunity logo or the statement. As with the insurance statement, it needs to be of a size that's easily readable. So again, if you're limited in size, we recommend you just use the statement as opposed to try to use the logo and the statement, because the statement is likely not going to be easily readable. So, radio or TV, you just say that, or you can have it come up at the last screen, whatever. But again, we're talking about dwelling related loans. So even if you're doing unsecured, but you're calling it a home improvement loan, that's going to be considered dwelling related because it's related to the improvement of a dwelling. So you need to have the equal housing lender, equal housing opportunity logo or statement in that advertisement. One other thing I want to point out here as well as we're talking about fair housing, watch out for racially exclusive images. Now, I did an advertising webinar, advertising compliance webinar for the Maine League, probably about 9 or 10 years ago. And I said, watch out for racially exclusive images. And somebody asked, or somebody said, well, probably about 96% of the population of our state is white. So what do we do? Well, unfortunately, there's not a magic percentage. But if you're using 4 different pictures, try and make sure not all 4 of them are white. So that's my recommendation regarding racially exclusive images. Next, let's talk about what your ads have to include when you advertise rates for both loans and for your deposit accounts. And before we even get into that, let me just say that there's no regulation that requires you to advertise your rates. You can simply say, we have great rates. There are specific stipulations, though, in the regulations if you do advertise a particular rate. And that's what we're going to talk about next. For purposes of your deposit accounts, the regulation that you're going to need to pay attention to is NCUA regulations part 707, truth and savings, not regulation DD. when Truth in Savings was passed well over 20 years ago, there was a provision in there that basically said that credit unions don't have to comply with the bank regulation, which is Reg DD, but that NCUA had to write a regulation that was considered substantially similar to Reg DD. So if you're doing research on what Truth in Savings requires for credit unions, you're going to look at NCUA Regulations Part 707. Under that section, an advertisement is a commercial message in any medium that promotes some kind of share accounts. So if you got to have the insurance statement, consider it an advertisement as well under Truth and Savings. So again, print ads, social media, radio, TV, those are all going to be considered an advertisement. Like I said, if you're talking about it, consider it, treat it as an advertisement. What Truth in Savings says is if you do include a rate for the share account or your share draft account, your certificate, your money market, whatever, if you include a rate, it has to be the annual percentage yield. You can abbreviate APY, but the ad does have to have annual percentage yield spelled out at some point. Okay, so again, if you are including a rate, it has to be the APY. You can include the dividend rate, but that cannot be more prominent than the annual percentage yield. So you can abbreviate APY, but somewhere in the ad, you have to spell out annual percentage yield as well. And under Truth in Savings, APY is the trigger. So if your ad includes a rate, the APY, then there are additional disclosures that are going to be triggered and have to be included in that advertisement. So if your rate can change, you have to include a statement that the rate can change or that it's variable. When the rate is effective, so that something along the lines of rate effective as of this particular date. If there is a minimum balance required to earn that rate, that has to be stated as well. If there is a minimum balance required to open the account and that's greater than the minimum balance to earn the advertised rate, that has to be included as well. That's a weird one. I have yet to ever see an ad for any credit union or even a bank where the minimum to open the account is greater than the minimum to earn the stated rate, which doesn't make sense to me, but that's what the regulation says. The last disclosure that you need to make sure you include, and this is one we see missing a lot, is a statement that fees could reduce earnings. So those are the disclosures that are triggered if your advertisement includes a rate. If it's a certificate advertisement and you include a rate, the other disclosures that have to be included are the term of that certificate. 6-month certificate, 12-month certificate, whatever, and then also include a statement that a penalty may be imposed or will be imposed for early withdrawals. Let me stop here because it just occurred to me that there was something I should have told y'all. I should have put in this program as well under Truth in Savings. If you're a federal credit union, you cannot use the term CD to describe your certificates. You can use certificate, you can use share certificate, you can use certificate account. You cannot use the term CD or certificate of deposit. That is stated in the commentary to Truth in Savings. Again, remember, we have a different rule that's substantially similar, and that takes into account the fact that we are a membership organization, so that the accounting treatment is different. from other institutions. That's why we can't use the term certificate of deposit, and we can't use the term interest to describe earnings on a share account. You have to use the term dividends. Sorry, I forgot to put that on a slide. All right, so under Reg Z, which implements the Truth in Lending Act, that covers loans. Under Regulation Z, an advertisement means any commercial message in any medium that promotes directly or indirectly a credit transaction. So newspaper, radio, TV, direct mail, website, interior and exterior signs, sorry. Basically, again, any type of a statement message, for example, promoting loans. So if you're doing some kind of advertisement for a lending product, Reg Z is where you're going to need to, where you'll find the regulations. Generally, under Truth in Lending, if an advertisement mentions any specific credit terms, it can only state those terms that are actually available. Now, under Reg Z, the advertising rules differ for open-end credit and for closed-end credit. Open-end credit is defined as consumer credit extended under a plan in which the creditor contemplates repeated transactions, that the creditor can impose a finance charge, and that the amount of credit that can be extended to the consumer is generally made available to the extent that any outstanding balance is repaid. Open-end credit are credit cards, lines of credit, and HELOCs primarily are what you're going to be dealing with, or what you need to think about when you're thinking about open-end. Closed-end, as defined under the regulation, is anything that's not open-end. So generally what we think about in terms of mortgage loans and car loans, when there's a specific term for that particular loan, that's generally going to be considered closed-end credit. And the thing you have to keep in mind is when you're planning an advertisement for your loan products, you have to figure out whether or not it's open-end or closed-end before you can figure out what other disclosures or what disclosures might need to be included in that advertisement. The rules for open-end credit can be found in 12 CFR 1026.16 and for closed-end at 1026.24. Under Reg Z, if you state a loan rate, it has to be stated as the annual percentage rate or the APR. The annual percentage rate, that's specific to Regulation Z. APR is a loan term. It basically indicates that the regular interest rate annualized. So it is a more true reflection of the loan costs. That's why if your advertisement includes a rate, it has to be the APR. Since one of the purposes of Regulation Z and Truth in Lending is to promote the informed use of consumer credit by requiring disclosures about terms and costs, using the APR in the ad really provides a better picture or more clear picture of what the cost of that credit is. So for loans, the rate is APR, annual percentage rate. Under Reg Z, you actually do not have to spell out annual percentage rate. You can just use the abbreviation APR. So that's different than under Truth and Savings. So for purposes, we're going to talk about open-end credit first. Again, your lines of credit, your credit cards, your home equity lines of credit. If an advertisement for an open-end product includes what are called trigger terms, stated either affirmatively or negatively, that's going to trigger some additional disclosures. These are the trigger terms for open-end credit. So the finance charge, if your ad talks about monthly interest payments of $10 or something along those lines, if your ad includes a rate, an APR, or a statement of when finance charges begin to accrue, that is a trigger term as well. Fees, such as balance transfer fees, fees associated with actually having the credit or associated with using the credit, those are trigger terms as well. Charges imposed for terminating the plan. I don't know why you'd include that in an advertisement, but for example, if you do, that's considered a trigger term as well. So if your ad contains, for your open-end credit ad, again, lines of credit, credit cards, HELOCs, include any of those stated affirmatively or negatively, it's going to trigger some additional disclosures. Here are some examples. That's why I, emphasize stated affirmatively or negatively. We see a lot: no closing cost HELOCs, no balance transfer fees. Those are trigger terms under Regulation Z. So if your ad includes any of those, these are the additional disclosures that have to be included as well. So if there's any type of minimum or a fixed transaction activity or other type of charge that's considered a finance charge that could be imposed on that loan, those have to be disclosed. If you've disclosed, if the trigger is a fee, then you also have to include the APR, the annual percentage rate that can be applied. And if that can change, if it's variable, you have to state that in the advertisements as well. The last one, a membership or participation fee, that's not the membership fee to join the credit union. That would be like a fee to actually have the loan. An annual credit card fee, for example, would be triggered. So if your ad includes these types of statements, these are the additional disclosures that have to be included for open-end loans. There are some additional disclosure requirements for HELOCs. Again, if there's a trigger term that's stated affirmatively or negatively, the no closing costs, that's going to trigger the disclosure of the rate, if the fees, if the rate can change, and other fees and other payment terms. So that's what's, let me back up. If your ad includes these types of things, as I said, no closing costs, any type of payment term or the rate, these are the additional disclosures that have to be included in that advertisement. If it's a variable rate, again, a statement that the rate can change and the maximum rate under the plan. Closing costs. Now, you might be thinking, all right, well, if we're advertising no closing costs, there aren't any closing costs. If your promotion, or if the advertise, or if the plan, it might be that the credit union is paying the closing costs, but if if the loan is closed or paid off within a specific time period, then the member has to repay those closing costs. Then your advertisement needs to include what those closing costs are. Also, if you require property insurance in order to get the loan, then that has to be included in the advertisement disclosures as well. So that's open-end and HELOCs. So let's talk about closed-end. Keep in mind, closed-end credit is any consumer credit that's not open end. So as I said, installment credit, automobile loans, mortgages, maybe home improvement loans. The main trigger term you have to watch out for with closed-end loans is the period for repayment. For purposes of closed-end lending, APR is not a trigger term. So you can say we have car loans of, whatever, 1.99% APR, and you've not triggered any disclosures, any additional disclosures. If you say we have 60-month car loans for 1.99% APR, that's the trigger term. And that's the one I think, most of the time that you need to be concerned about when you're doing any type of advertising for closed-end lending. It's that term. So if that is included in the ad, then there are additional disclosures, the APR, the terms of repayment, basically a payment example. And that can be done one of two ways, either an exact payment schedule, a $10,000 loan for 60 months at whatever that APR is, monthly payment would be whatever. Or you could do a unit cost approach, 44 monthly payments of $27.15 per $1,000 borrowed. Keep in mind, however you do it, your payment example should be based on the term and the APR that's advertised. So if you're saying we have 5-year car loans, 60-month car loans, whatever, you're going to trigger the APR for that and then a payment example. Closed-end lending is a whole lot easier to advertise, in my opinion, than open-end lending because the disclosures are a whole lot less. Now, there are some additional requirements if you're doing an advertisement for some type of a mortgage loan that's a closed-end loan. If you're required to include a payment example, you have to include a statement that the payment example doesn't include taxes and insurance, and the actual payment will be higher. If it's like an adjustable rate mortgage that you're advertising, you have to include in the disclosure, the advertising disclosure, the amount of each payment that will apply and the time period for that. If there's a balloon payment, that would have to be disclosed as well in the advertising disclosures. So just a couple of extra things to think about, to keep in mind when you're doing mortgage advertising. Now, there is a provision in Reg Z that provides an alternative way to do ads that might be on radio or TV. And it's basically, the requirement is basically the same for whether it's open end or it's closed end. You can either, in the advertisement, if somebody can talk fast, if it's radio, or it can come up on the screen if you're doing a TV ad, you can include all of the disclosures that we just talked about, or you can include the APR and then some kind of toll-free number that the member can call to get more information about the loan. So call 1-800, whatever the number is, for details about credit costs and terms. The regulation talks about it in terms of the number that can be used to obtain additional cost information. So in disclosing that number, you need to talk about it in terms of where they can get more information about the cost of that particular loan product. So again, this is for advertisements for radio or TV. Doesn't matter the length. It just, you either include all of the disclosures or the APR and a toll-free or a reverse charge number, if anybody still has those, where the member can call to get additional information about how much it's going to cost for them to borrow the money. Okay. And just when you thought you had the intricacies of Reg Z advertisement requirements figured out, they threw in some quirks related to advertising promotional rates and terms, or promotional rates and fees for credit cards and for HELOCs. Again, this is something that we are seeing more and more of. Credit unions doing a 0% balance transfer, or 0% for 12 months, and then whatever. That's considered for a credit card, that's considered a promotional rate. So, like I said, 0% APR for a specific term, or a reduced rate, again, for balance transfers, for example, for a particular time period. That's considered a promotional rate. If the promotion is for new cards, that's considered an introductory promotional rate. So keep that in mind as well. So if you're doing a push for new cards that has a reduced rate or a promotional rate, that's going to be considered introductory. And that term has to be included if you're disclosing the rate. So if you are, again, if it's some kind of promotional rate for a credit card and you include the rate, you have to include these disclosures as well. As I said, if it's a new card, intro or introductory, when that promotional rate will end, how long that promotional period is, what the rate will be for that particular entity or that particular type at the end of that promotional period. All of those have to be disclosed in close proximity and with equal prominence to the promotional or introductory rate. That's where we're seeing a lot of mistakes. What the regulation says is that having that information in a footnote is not sufficient. So if you're doing the promotion 0% APR for 12 months, then the rate that is going to be in effect at the end of those 12 months has to be disclosed in close proximity and with equal prominence to that 0% and that 12 months, the time period as well. So however big your promotional rate is, the time period and the rate in effect after that promotional period have to all look alike, equal prominence and close proximity. And it's the same general requirement, if you're doing some kind of promotional fee, you're doing a balance transfer for existing card holders with no balance transfer fee for X%, or, for a specific time period. Again, the rates or the required disclosures are the same as if you were doing a promotional rate. And generally, it's the same for HELOCs. If you're doing a promotional or a teaser rate, which is basically a variable rate that's not based on an index or a margin that would be used later in the life of that loan. So a promotional rate perhaps during the holidays for a home equity line of credit. So if you're doing some kind of, think about it kind of in terms of a teaser rate, and you're advertising that, then you also have to include, as with the credit cards, the time period that rate is in effect and the rate that will be in effect at the end of that promotional period. And if you don't know that because it's a variable rate and that's based on perhaps prime, so if it's for 12 months, you don't know what prime is going to be in 12 months, you would disclose a rate that would be in effect if the promotional rate weren't in effect right now when that advertisement is done. So it's the same general idea for credit cards and for home equity lines of credit for your HELOCs. If you're doing some kind of promotion, your ad has to include what the time period is for the promotion and then the rate that's going to be in effect at the end of that time period, that promotional period. For HELOCs, you don't have to worry about the term intro or introductory. That's specific to credit cards. So now let's shift our focus from the definite, where we've got regulations that say specific things, to the nebulous, which is UDAP, unfair, deceptive, or abusive acts or practices. Dodd-Frank added the abusive part. It used to just be UDAP. They added the abusive, primarily attributable to the mortgage meltdown and overdrafts. Important to understand that for UDAP, there are no implementing regulations. It's just unfair, deceptive, abusive acts and practices, okay? And this is administered primarily by the Consumer Financial Protection Bureau, the CFPB. And the CFPB has said that they have no intention of issuing any regulations for UDAP. They're going to use enforcement actions and guidance to regulate UDAP. So as you think about UDAP, a good thing to do is to review what the CFPB puts out in things like its blog, other communications, enforcement actions relating to UDAP. The idea behind UDAP is you can't make promises you don't intend to keep or you have no way to keep. And it is especially true as it relates to advertising. Now, as I said, the problem with UDAP is that there is no regulation, and what's unfair or deceptive to you might not seem unfair or deceptive to someone else. So UDAP is very subjective. So I pulled this quote from U.S. Supreme Court Justice Potter Stewart in a ruling that dealt with pornography back in I want to say in the 60s even. If you substitute hardcore pornography with UDAP in this quote, you'll get an understanding of how difficult it is really to define unfair, deceptive, or abusive acts and practices. It's one of those, I can't tell you, I can't define it for you, but I know it when I see it. So what are we talking about when we're talking about unfair, deceptive, abusive? The standards for unfairness under Dodd-Frank is that an act or practice is going to be considered unfair if it causes or is likely to cause substantial injury to consumers. That key phrase is substantial injury, and that means monetary harm. And that harm is, or that injury is not reasonably avoidable. Does the act or the practice hinder a consumer's decision-making process? So, for example, not giving all of the information so that the consumer can do an apples to apples comparison. That's going to be considered unfair. With regard to deceptive, first think in terms of it's going to be considered deceptive if the representation or the omission of something is likely to mislead the consumer. So you have to kind of look at that in the context of what's going on, not just a specific statement. The FTC's 4P test can really assist in evaluating whether a representation or an act or practice is likely to mislead. Is the statement prominent enough for the consumer to notice? Is it presented in an easy to understand format, in language that normal people would understand? Placement is the placement of that information in a location where consumers can be expected to look or to find it. And is the claim in it, or is it in close proximity to the claim that it qualifies? The thing to keep in mind with respect to deceptive, if it's so small and so far away, it appears that you're hiding something. So kind of keep that in mind as you're thinking about deceptive. And then abusive, it's going to be considered abusive if it materially interferes with the ability of a consumer to understand a term or a condition of the product or the service, if it takes advantage of their lack of understanding, and if their reliance on what's said is contrary to their interests. The way I think about UDAP, and I have yet to find a way to really eloquently say this, but the way I think about it is you have to think about UDAP in terms of your most basic member. Is your most basic member going to understand what it is that the advertisement says, what it is that any claims made, what they mean? Is, a person of normal intelligence going to understand it? If it takes someone with a master's degree or a law degree to understand what your disclosures say, then you're violating UDAP. You can pretty much assume that that's going to be the case. You can look at the CFPB's examination manual. They have a whole section on UDAP, and in fact, they just reissued that, talking about it in terms relating to fair lending as well. As I said, the CFPB has repeatedly said that they're not going to issue any regulations. They also say in that examination manual that even though an ad might comply with the regulation, so it might comply with Reg Z or it might comply with Truth in Savings, it could still violate UDAP. So that's why I talked about it in terms of it, it kind of being really nebulous. But again, think about it in terms of your most basic member. Will that person understand it? The idea, your advertisement has to be truthful, not misleading. You have to have evidence to back up your claims, substantiation, and the advertisements can't be unfair. So just want to go over a few examples. We have the best rates in town. Did you poll every financial institution in town to determine that you have the best rates? If not, then don't say that you have the best rates in town. You might say we have some of the best rates, or we just have great rates. But when you say you are the best, you need to be able to prove that. We'll beat the competition. Really? Honda was doing 0.99% APR financing when I got my new my Pilot a couple of years ago. Can you beat 0.99%? If not, you can't say that you'll beat the competition. These are things we see a lot. Anyone can join. Well, as you know, we are a membership, credit unions are membership organizations, and not anybody can just join. So anytime you're doing that kind of a push, include a disclosure that says membership eligibility required. Free checking. If you are advertising some kind of an account that is considered, that you are advertising it as free, there can't be any type of maintenance or transaction fees. So if there's a monthly maintenance fee, you cannot call it free checking. Insurance, we talked about that. One of the big possible UDAP issues is using rates as low as without any type of qualification. If you risk-based price your loans and the as low as rate is generally the A+ rate, which is what most credit unions advertise, but unless a huge majority of your membership gets the A plus rate, you need to have some kind of disclaimer, at the very least, a disclaimer that not all applicants will qualify for the lowest rate. If rate depends on things like credit worthiness and the loan term, state that. Another one we see a lot is, that kind of goes back to the competition. We'll beat the competition. We'll match competitors' rates. If you're doing that kind of promotion, include some kind of disclaimer, disclosure in the advertisement if there's a floor rate, and also then that not all will qualify. Skip a pay or no payments for a particular time period. Include in your advertising disclosures for a skip a pay that interest will continue to accrue during the month or during the time period. For a delayed payment, interest begins to accrue when loan funds are dispersed. I see this a lot in loan ads on websites, especially related to mortgage loans in terms of or even car loans, get pre-approved so you can shop with confidence. Is everyone going to get pre-approved? If not, then you've got a problem. You should not say get pre-approved, say apply for pre-approval. Same along the lines, I see a lot fast approvals. Well, not everybody gets approved. So talk about it in terms of decisioning. Another issue, include an expiration date for promotions. If you're doing a summer promotion and you're printing flyers or postcards that advertise like a 24-month super saver loan of whatever, include what the specific time frame for that, including the year, or at least something along the lines of offer subject to change at any time. Loan calculators on your website, you should have some kind of disclaimer that, use of it doesn't guarantee credit. Advertising loans that aren't really available. I don't see that a lot. That tends to be more in the banks. We also recommend, if you are advertising your mobile app, especially if you're advertising it as free, it might be free for me to download it, might be free for me to use it free, in terms of the credit union, but I might get charged data fees. So we recommend including a disclaimer that data rates may apply. Also, as I said earlier in March, the CFPB announced that they had updated their UDAP section of their examination manual. So take a look at that. Just some other general recommendations that we make to our clients with regard to UDAP. If you're if you're saying a promotion good through such and such date, explain what that means. Is it that the ad has to be accepted or has to be received by that date? The loan has to close by that date, whatever. Again, you want to make sure you're explaining things so that nobody's going to misinterpret or misunderstand. That's the idea behind UDAP. Now, I'm pretty sure this is what everybody's been waiting for. And I think we can get it. We can talk about it in the time we have left. One clicks. For your electronic advertisements. What's electronic advertising? If I'm looking at it on my computer or on my phone, it's going to be considered electronic. So Google ads, Facebook, Insta, Twitter, your website. All of the ads, all of the requirements that we just spent the last 45 minutes talking about apply to your electronic advertising. So keep that in mind as well. Now, there is there are a couple of provisions in both Regulation Z and in Truth in Savings that talk about disclosures for electronic advertisements being what's called one click away. Okay, so and I included for your reference the provisions in the commentaries for Truth in Savings and for Regulation Z. So some of the disclosures that we talked about earlier can be one click away for your share account advertisements and for your loans. These are the disclosures that can be one click away for your share account ads, electronic ads. If I can click and go to the ad or go to the disclosure, this is what can be one click away, all of that. What cannot, all right, I'm getting ahead of myself. Regulation Z, these are the disclosures, the triggered disclosures that can be one click away. So most of the Reg Z disclosures and most of the Truth in Savings disclosures can be one click away. What can't be one click away, your share insurance notice and the annual percentage yield. That's not included in one of the one clicks for your share accounts. For your loans, the equal housing logo or the statement. And then we talked about the promotional disclosures. The ones that have to be in close proximity, those can't be one click away. Everything else can be one click away. Okay. With regard to your one clicks, they should be clearly marked. Just having it hyperlinked is probably not going to fly. It needs to, again, I need to look at it and say, oh, I need to click here to get more information about, my apologies, I thought I had silenced my phone, about the costs of the loan. The one click means one click. That's kind of a duh, but I say that because oftentimes a one click will take the reader to a landing page, which talks about the promotion, for example, but then the additional disclosures are linked from that page. That's not one click. The one click should take me to the disclosures. I talked about the Reg Z for the loans and Truth in Savings for the share accounts. UDAP, there are no provisions. There's no regulation in UDAP. So you have to make a business decision with regard to your things like as low as, your deferred payments, your skip-a-pay disclosures, any of the UDAP disclosures. You make a business decision whether or not you're going to have those one click away. So I will ask if we have questions. I see a couple in the chat. Okay, I went ahead and pulled them up, so I'm just going to address them. I was told recently that the APY is required to be quoted before the APR, even if it's done verbally. Okay, well, APR and APY are two different. APR is not a loan or is not a share term. So when you're talking about APY, you're talking about dividend rate or interest rate, not APR. APR is a loan term. And I quoted, I get done verbally. Well, again, if you're disclosing a rate, it has to be the APY. You can include the dividend rate or the interest rate. So I would probably agree with that, that the APY should be first. Is it okay to state loan rates based on credit worthiness in the fine print? Yes. I will say, though, my preference is instead of that to see not all will qualify for the lowest rate, because you can't guarantee that a consumer who reads loan rates are based on credit worthiness is going to make the mental leap to they might not get that lowest rate. So if you're only using one statement, my recommendation would be not all qualify for the lowest rate, but that's a business decision.
Kristen, one quick question that came in, and I know
Okay.
it's past time, so if folks do need to drop, let me just say quickly, thank you so much for joining us, and feel free to stay on so we can work through some questions. But if anyone has to drop, this was recorded. I know there's a lot of information here, a lot of really important information. So I will get this up on the Marketing Council's website so that you can go back and rewatch it. But Kristen, in terms of some of the trigger terms that you were discussing at the beginning of your presentation and the disclosures that you need to make if you have some of those trigger terms, do you have good examples of those kinds of disclosures that you've seen others use?
Of the triggered disclosures?
Yeah, when you have one of those trigger terms that you talked about, and then you have to do a disclosure. Do you have like a good example of that?
I probably can find some, and I will do that. And now I'm going to do that with a caveat, with a preface, okay? That's going to be a sample, and I can't guarantee that it contains everything. But for example, like the HELOC, all of the HELOC disclosures. Yeah, I can pull a couple of those.
Perfect. Thank you. That was just one of the questions that came through. So thank you.
Yeah, I can do that.
And
here's my contact information also. So if you've got questions, when you're going back through things, shoot me an email. I'm happy to help if question comes up later.
For those that are still on, and thank you, Kristen, for hanging, additional questions that we can go over. Let me check the chat. Don't see any in the chat. By all means, team, this is a great opportunity.
And I'll tell you, we covered in a little over 60 minutes what normally takes about 2.5 hours. So I tried to pull the things that I thought were most important.
Yes, it's certainly great information. So yes, and I know folks will want to receive this again. So this is why we record it, because this incredibly valuable information. So we absolutely will get this up, but I will let everybody know, once I've got it on the website, that for those who registered, I'll send out the link. But Kristen, thank you, your time, your talent, your expertise in a field that is so complex. Every credit union needs a Kristen. So we greatly appreciate it. There's a lot of intricacies to this. So thank you.
I appreciate the opportunity, and I'll work on getting some samples put together for you.
That'd be fantastic.
Get those sent. I can't promise it'll be today, but by the end of the week, I'll get it to you.
That's wonderful. All right. Well, much appreciated, Kristen. Thank you to everyone who joined us today. Thank you so much. It's always great to see you all and connect with you. And if you all have any questions or need anything further, just send me an email. So thank you all. Take good care.
Thanks. Bye, everybody.
Bye, Kristen. Thank you.